The United States equity market has been by far the best performing equity market of any developed nation in the world over the last century. Part of the reason it has performed so well is because the level at which it makes up the global equity market has increased drastically over this time period, now taking up around 60% of the entire global equities market. The performance and outperformance of US equities could very easily continue over the next century, but whether or not it does is actually less important than how concentrated its dominance has become. And what history tends to look like when one market sits at the center of the global system for so long tells us a very interesting story and enables us to make a very simple decision to mitigate the potential risks of this situation. Before getting into the specifics of how to solve this problem and how I'm going to solve it for myself personally, one simple historical anecdote I think is very valuable to discuss here, and that is Japan into the 1980s. Where into 1989, Japan's equity market exploded significantly more than the US one for about 40 years, and towards the end of the 1980s, Japan's equity market was worth around 45% of the global equity market. And if you skip forward 40 years, it sits at only around 5% right now. And as I'm sure most are aware, Japanese equities have done nothing for about the last 4 decades. I'm certainly not suggesting that that could or will happen to US equities. However, the US now sits at closer to 60% of global equities. And while Japan didn't collapse, its period of dominance didn't last forever. And over the next century, I think it's very possible that something similar or even remotely comparable happens in America, in the sense that the level of dominance could perhaps go from 60% of global equities to 40%. And even if that happens, the level of underperformance you would have versus ex-US equities would be around 50% in that case, or around that number. But what's important for looking back at Japan is that the market collapsed, but Japanese companies continued to exist, innovate, generate profits, the same as perhaps you could say about our tech bubble. The issue was, of course, the relative performance of Japanese equities versus the rest of the world, where for decades after its peak, Japan simply stopped being the engine of global equity returns. And I'm saying that perhaps that risk is more apparent in America now than it has been at any other point, which is simply the risk of concentration. It doesn't necessarily have to be a crisis or a dramatic regime shift. It's something that can simply happen, perhaps because other countries start innovating at a more extreme level than we do. And while our returns are high, theirs become higher. Or perhaps there's something to do with the price ratios we experience here versus the price ratios of the rest of the world, and perhaps they catch up or we drop lower. In any case, there's a lot of risk simply relating to that concentration. The approach to mitigate all of this risk very simply, that is perhaps the cleanest, although there's another one we'll discuss later, is to simply hold global equity ETFs instead of simply American ones. And if you look at an ETF like VT or URTH, their exposure is already 60% or so US stocks. So in switching from an S&P ETF to say one of these, your exposure to the S&P 500 remains nearly 60% of what it would be otherwise, and the other 40% becomes the rest of the world. And if America continues to dominate, you still see virtually similar or identical returns, given that if the US percentage of global equities stays at around 60%, which perhaps is some near maxed out level, your returns are hardly mitigated. However, if that shifts from 60 to 40, or God forbid lower, you have made an incredible decision that has buffered you from extensive US underperformance. Of course, if US equities continue to improve their position in the world, you would underperform what you would in just the S&P. But of course, that's almost the best case scenario, because that means you have essentially maintained maximum equity exposure, 60% of which is in what has clearly still been the best performing equity market in the world. So in that case scenario, while it ended up being the suboptimal decision, it certainly wasn't a bad decision. And all you're effectively doing is moving through the same strategy of market cap weighted systems, just from American specific concentration to global. URTH, I believe, has around 1,200 total holdings, most of which, market cap wise, are still American. So it's effectively the same rationale that works so well in US indices, that the companies that continue to perform the best will gain larger and larger weights, and the companies that perform the worst will eventually leave the index. But in this case, it also sort of has that country aspect, where if one country continues to improve, continues to raise their level of domination in the world, they will become a larger and larger percentage of your portfolio. And obviously, as a result, potentially American stocks would lose that concentration. The other approach, in contrast to switching from US exposure to global exposure, is to simply add ex-US exposure while maintaining your identical US positions. Say you're dollar cost averaging into the S&P. Instead of continuing to do that or entirely doing that, put some of that into, say, an ETF like ACWX, which is the ex-US ETF. And if something is to happen in America concentration-wise, similar to some of the risks we've discussed, you then compound that at a different rate in only ex-US assets and also sort of have that currency buffer as well, considering the level of outperformance that is common in ex-US ETFs and ex-US holdings when the US dollar depreciates. For my ending remarks to this video, all I'll say is that what matters most here isn't the specific strategy chosen, whether it's switching to global ETFs or adding some ex-US exposure. It's the idea behind it and the fact that you keep it in mind in general if your investing horizon, like mine, is many decades. It's not a bet against the US. It's not a prediction that leadership is going to change. It's a way of staying fully invested while potentially reducing some of the risk that comes from being invested in such a concentrated global market that is so heavily weighted in the favor of the US. Adding global exposure, whether through a single global ETF or US plus ex-US ETF or just an ex-US ETF, is not about needing to be right. It's not about betting against America. It's about hedging the very real potential for US dominance to wane over such a long time frame as it has for other countries that have been in similar positions to where we are now. If other parts of the world begin to lead, your participation is automatic in them. And if other countries do not begin to lead, then that means you are already overweight and very heavily exposed to what is assumed to then be the still best performing market in the world. So it's just about having that risk nullified and entering into sort of a no-lose situation as long-term investing really should be. That's about all I have. If you enjoyed this or found this insightful, please consider subscribing. Thank you.